Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, June 21st, 4:49 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in a correction. If you've been following us for a while, you know that. If you follow the markets, you know that. Check over here the trend gauge, and we are still consistently red across all three time frames and across leadership. From the three time frames, this means that all five of the major moving averages that we cover in these videos are below their short-term 21-day exponential moving average, their medium-term 50-day moving average, and the long-term 200-day moving average. We use this as a signal for how much we're willing to get invested in the market. And then, of course, leadership, you got to have that to outperform the market, and that's lacking as well. So as far as what happened today, when you see green, it's very easy to get excited when you're in a downtrending market, but we have to call it like it is. And all this is an oversold bounce in a bear market. One of the learning curves that I struggled with is trying to determine when you get excited about things being green and when you just have to be patient and let things play out, and frankly just be patient for the market to fail again. It's no different than when you're in an uptrend and you pull back to a key moving average than when you're in a downtrend and you spike up into the moving average. The expectation is that you should fail at those resistance areas. So getting out over your skis, getting heavily invested just because you see a green day in the market or even a couple of them is really not the optimal way to play, where we really need some confirmation that there is some sort of a true bottom taking place. And that confirmation, we're going to use the short-term 21-day moving average for a start. And secondly, we're going to use some market leadership so that we've got a place to put our money. So green on the screen on the day, but as I said, just an oversold bounce in a bear market. G6 up 2.5%, S&P 500 up 2.5%, NASDAQ 100 up 2.5%, Dow up 2.2, mid caps up 1.25, Russell up 1.7, diversified global 60/40 stock and bond up 1.11%. GROTECTION down on the day, down 0.02%. Does that concern me? No, that does not concern me. Let me show you why. We have an expectation of how our portfolio should be doing depending on where we stand with various market conditions. And this is a chart I bring up frequently. It's one I refer to all the time to try to measure what we're doing. Basically, I've identified 9 different types of markets here, from a strong bull market to a bear market, and then transitioning from a bear back up to a possible uptrend. So right now we're off the lows by a couple of days. So I want to keep track of, are we transitioning from a correction to a bear? Is it a true early recovery, or is it just a bounce? I said for now we're treating it as just a bounce. And what should I expect in my portfolio, since we are growth investors in a bear market? What should I expect? And I'm expecting moderate underperformance, and I'm okay with that. Take a look here. Right now, off the lows, 2 days, we're flat in our internal portfolios in-house, while the market has bounced 2.7%. So I'm saying this is where we are right now. But year to date, we're down 7.8%, while the market is down 23%. So we're outperforming over this period where we're in a bear market. We would expect major outperformance. That's what we're getting. But of course, we're going to transition. We've transitioned twice recently. March 15th to 17th, the market was up 5.7%, while we were only up 0.3%. Market in May 25th to 27th, market was up 5.5%, while we were just barely above flat. But in both cases, the market then rolled over. And again, It's because of the type of market, the overall market that we're in is a bearish environment. So I know I'm going to underperform at the turn. I'm not concerned about it because there are times when we're going to have major outperformance. A bear market is one of them. A strong bull market is one of them. And then there's different flavors in between of whether we're correcting or we're in an early bull market or a mild bull market. And this is an expectation that we have for what we should be doing. So I refer to this frequently, and it helps keep me grounded and keep my expectations in line for what they should be. So, okay, we went over what just happened today. Next up, we're going to go to tail of the tape and the chart. Since our 21 over 21 leaders list is completely broken down because of the state of the market, I'm going to show something that I'm using to rebuild it. So here's the tail of the tape. Let's before we get into this, let's get into the team here at Revere. Trend following is what we do. Participate in uptrends, pull back a little bit during consolidations, get the heck out of the way during bear markets. You know where we are today, so you know how we're positioned. And if you're interested in this approach, reach out to any of us. You can email Dan, Tim, Hunter, Muriel, or Don at revereasset.com or call 855-REAL-WEALTH. That's 855-732-5932. Following up on my interview with Richard Moglen of Trader Lion, what a fantastic response we've gotten to that. Richard does a great job with his interviews, and it gave us an opportunity to tell our story to Revere to a wider audience than we normally would reach. I know there are a lot of traders that watched the interview, and we got a lot of questions and a lot of kudos from there. But to those traders, a lot of them manage their own portfolios, and we're glad to help out with tips and tricks. But if you've got family members or somebody with an old 401k sitting around and just concerned about losing money, send that video their way and see if they're interested in an approach a common sense approach where we can get out of the way when the market is failing. You don't have to just sit there and give back your hard-earned gains. After all, it's not how much you make, it's how much you keep. So let's get to the indexes first of all. So here's the S&P 500. You can see after a tough downtrend here, all we did is have a bounce off the lows. We're still, this is showing 8.4. The actual S&P 500 is closer to 8.2% below the declining 50-day moving average. So we've got a declining 200, a declining 50, that's the red line, a declining 21, that's the green line, and a declining 80 MA. So it looks like we're possibly coming into a test of this declining 8 EMA. That's the first thing we're going to see is how we react there. Let me dive into this a little bit more and bring up a 15-minute chart, because what we're seeing as of right now is this. Hold on, let me bring up the S&P 500. So here is the failure of the uptrend. This was before the Fed. Then we had the Fed day and we had a rally up, although it was another gap down. And then this was the post-Fed day where we had the gap down. So this is the range that we're in right now. The high is 38.38. We need to get over that to try to fill the gap to the gap down from Fed day. And then on the downside, we're at 36, 37-ish. But right now, so what did we accomplish with this gap up today? Well, very clearly 3,700 here was a support area from June 14th that was broken on the 16th and the 17th, and we gapped back up above it. This gives us a good reference point on a pullback. Any pullback, if this is going to turn into something, if we're going to get a follow-through day, if we're going to get a continued rally and have some leadership in stocks, we're going to have to survive any pullbacks. The first level that we should hold on a pullback is today's lows, so around 37.30, and then the next area is this 3,700. We want to see that what was formerly support here on this 3-day pullback turned into resistance on the 16th and the 17th, and now we gapped above that level of resistance today. You can see over here, if you go to the tail of the tape, here's this 37.10 to 735 area that we gapped below on 615. Now we got back above it on 621. So tail of the tape, we're back above there. Any pullback, we want to hold this area. It's broad, say 3,700 to 3,735. We want to keep that area on any pullback. So, and then above there, we've got all of this, really a lot of resistance when we get up to this 38.13 to 38.55 level. That's the 20% year to date figure, a 38.2% fib of the whole COVID move. 20% off the all-time high close and 20% off the all-time high from late last year. And one at a time, we'll get through these areas if we're going to turn into a sustainable rally. And if we're in a sustainable rally, we'll put our money to work as long as, and finance future gains with the gains that we are hoping to make from re-entering the market. And speaking of re-entering the market, when we recaptured this 3,700 today, actually the gap up, that got my attention, and we started looking for what is a chance, what is a reasonable level if we want to play a bounce up to some of these levels where, as of right now, we're kind of expected to fail. So this ADMA and this 3,800 area is a lot of resistance. Wouldn't surprise me if we fail there, but there's no guarantee that we're going to fail there. And if we do continue to go higher, we want to participate a little bit, make a couple of tenths of a percent or a percent if we can, and then regroup if the rally fails. So after we got some initial strength in the morning with this gap up, we had 3 5-minute bars higher, and then we consolidated for a little bit, and then we broke above it at this 9:55 5-minute bar. So this was the signal to initially, this told me at least early in the day that we weren't going to immediately break down. It gave you a pivot that you break above, and it also gives you a stop, which would be a little bit below the low of the gap up day. Now, this told me that I wanted to participate at some point today, even if it's just a little bit of, as I said, a little bit of a tactical, not necessarily a strategic long, but a tactical long to make a little bit of money. So I then go to the 5-minute stochastic here, and the 5-minute stochastic tells me a couple things. You always see multiple highs intraday and multiple lows intraday, overbought being above 80, oversold being below 20. If I want to participate, the odds are that I don't want to buy up here. I want to wait for some sort of a pullback, so at least I'm getting a good price. There's nothing worse than you see FOMO, you see something going strongly, you make your decision, you get into it, and then an hour, 30 minutes later, you're down 1% right away. So when I have decided that I want to get an entry, I go to a shorter time frame and look for coming off of an oversold level, preferably also corresponding with a pivot that I can get in. So as I said here on SPY, the pivot around this 374 area, we're oversold here. We got up to 376-ish. So let's see if we can get a pullback close to this 374 area, corresponding to a low on this 5-minute stochastic, and it can give us a little bit of a lift off to at least make sure we got a good entry point. And we got that shortly after 12 o'clock. We came back to this pivot, and then we got the stochastic crossover as we came off of that pivot, and this was the entry point that we used to take a 10% position in SPLG, which is an S&P 500 long ETF. So we got our 10% position, and then after we have it, it's just a matter of deciding, do we want to add to it? Do we want to sell it if we get stopped out? So right now, this 374 area, any pullbacks have survived that 374 area, so we want to hold on the SPY this 374 area, and then we certainly want to hold the low of the gap up day. So we have several options for how we'll play this. We'll keep an eye on it. As I said, it is just a tactical long. We're not expecting to hold this for an extended period of time, but we do. Maybe the low was put in. You have to be open to all possibilities when you're dealing with the market, because if something seems to be a sure thing, I can guarantee you in the market it's not. Maybe this is a low. As of right now, we're just playing it the same way we would play a pullback over here to a moving average that works until it doesn't. Right now, we're in a downtrend and we're failing at various moving averages until we aren't. That was how we played it here. We got above the 21. We took a couple of longs, lasted for 7-8 days. We broke down. When we broke down, our stops were hit and we got back out, and we missed this whole move down after the breakdown from our range. So let's see what happens with this long as we come into these declining moving averages. Now, as far as isolating strength, well, let me finish. Let me go back to the 21 over, or to the tail of the tape, and then we'll talk about isolating leadership as we try to rebuild our leaders list. So right now we're on this bear case because of the failure on 610 of the rally that we were in. A little bit of news today: May existing home sales weak, and they're expected to be weaker. So what we were watching coming into this morning, over the weekend, I said, I was expecting this resistance area to be 37.10 to 37.35, but we gapped above it. So that flipped that resistance area to support. So any pullback, we want to hold this area. And then I just went up to the next higher resistance area, which is that 3,800 plus area that I talked about. So this is what we're watching coming in today. The action, I kind of described it already. We gapped up. We went as high as 2.8% by 11 o'clock, and then we based for the rest of the day in a tight range. I am seeing many oversold charts starting to turn up on their daily stochastic, including, you can see here, the SPY. So we're oversold, and we finally got the hook. Now we've got it several times back here and it failed. It's certainly no guarantee, but sometimes, like here, it does. You get a nice move off of it. You got a nice move off of it back here. So we'll keep an eye on what's happening. As for right now, we're still oversold, but we're trying to work off this oversold condition, and continue to move higher will give us the opportunity for at least a bounce, a continued bounce from this oversold area. And the fact that we're still 8.4% below this 50-day moving average, historically, that's pretty stretched to the downside. Take a note of this last bounce here that finally worked. We started out at 9.2% below the 50-day moving average, and we bounced from 380 all the way up to 417 before we couldn't go any further. We ran into the declining 50-day. And then the Fed came out and we broke down from there. So what we want to do from leadership, well, I'm getting ahead of myself again. Let's finish going through this. Many oversold, daily stochastics turning up. All 11 of the S&P sectors were up today. Oils were the strongest after really taking a beating for the last week. Bonds were weak, GLD was weak, and the agricultural commodities were weak. Wheat, corn, and soy. I mentioned we bought 10% SPLG, so our adjusted beta is at a 0. Our volatility adjusted beta is at a 0.11%. For the bottom line, we're in an oversold bounce, still 8.2% above the 50-day moving average. So in other words, we're in a bear market. We had an oversold bounce. There's more to go on the upside, and we'll take it one day at a time and see if we can get through these various levels. So let's talk now. Let me go to a 15-minute chart, and I want to focus on 7 candles here to isolate strength in individual stocks. And here's the first candle. This was the big gap down on 610, and this is after we broke below the bottom of this range. Okay, so then the next day we had another gap down. That's day 2. We made another lower low on day 3. We tried to rally on day 4. And then we failed on day 5, day 6, and now we had a gap up on day 7. Okay, so this was the first failure on 610. Another follow through to the downside on 613, 614, a bounce on 615. Big failure. This was Fed day, 615. Next day, big gap down, another lower low, and now a gap up. So let's go to this on a 15-minute chart, and you can see here's day 1, 2, 3, 4, 5, 6, 7. So we want to compare charts of various stocks. We make this a little bit bigger, and we want to see how strong they are relative to this 7-day pattern. Out of the gate, let me tell you one that's a miserable failure, and that's Meta. So compare that 7-day chart to the Meta 7-day chart. This is one of the weakest charts that you'll see in the market. But then let's compare that to Tesla. So day one on 610 here, here's the gap down. We're actually above it. We didn't have the big 2-day gap down the way we did in the markets. And now we're already back above the first day of the 7 days that we want to focus on. So Tesla, to me, very strongly stands out from a relative strength standpoint based on this big gap down that started on 610 compared to where we are right now. So we're going to compare. This is what we're doing. We got our 2121 list is decimated, but we want to try to rebuild it, and we want to compare charts to that 7 candle pattern that we saw on the S&P to see how we're doing relative to that to isolate strength. And here are some other stocks that jumped out to me. Tesla looks good. GTLB is another one to add to the list. Not as strong as Tesla, but here's the 610 day. Anything that's up near the top of the 610 day is very clearly showing relative strength over the last 7 days. I mentioned 5 stocks on Friday of the video that were at low risk entries. Schlumberger was one of them, still below, well below, but it did bounce off the 200 day. It was up 6% today, but this is not the strongest chart. All of the oil charts basically look like that. So we're looking for non-oil charts. Not saying that oil's not going to have another leg up, but this was a very vicious week and a half sell-off in oil, and they went from being the leading sector to currently being a lagging sector. One of the other stocks that I mentioned was Li Auto. This is far and away one of the nicest charts that you'll find. Here's the 610 candle. Compare that to where it is now. Ticker LI. Zoom, I've talked about that, about how much I like the way that it acted since its earnings report. Here's the 610 gap down day. Not only did it get above it back here on the 15th, not make lower lows on the 16th and 17th the way the market did, but actually made new highs relative to this 610 day before pulling back later in the day. So Zim looking pretty good. Ollie's another one, OLLI. This is one of the 5 that I talked about. 7-day highs. Again, look at the relative strength line. So what we're trying to do here is isolate relative strength as we rebuild our watch list. UTHR, here's the 610 day. Sorry, here's the 610 day. We're above the 610 day. So definitely, and look at the relative strength line on that. Very clearly that belongs on it. Chewy, this one has been really chewed up and spit out, but it's kind of like a bottoming pattern, very similar to what Zoom is forming. I understand it's below the 200-day moving average, but you've got insider buying here coupled with a nice 7 candle combination relative to that 610 day. Big gap up today with some volume coming into it too. So put it on your list. Some former leaders will come back. Some certainly won't. Enphase is another one that's looking good. And again, we're isolating this 7-day pattern. Here's 610. Came up into it, not quite as strong as the other one, but again, also notice the stochastic crossover happening back to the upside. T-Mobile, one that's certainly acting very well back above that 610 day. Google, this is coming into its split day, so this relative strength might have something to do with that, but be that as it may, it is showing relative strength, certainly relative to what we showed with Meta. And then finally, Lilly, this is one that led for a while, had a pretty harsh pullback, but it's right back into this 610 area and fighting to get back above its moving averages, and it has the stochastic cross. So that's a tool to use if you're trying to rebuild your watch list. Compare what happened over the last 7 days to what happened in the S&P 500. Also very similar to what happened in the NASDAQ 100. If it's in the tech arena, you can compare it to that. There's your 610 gap down, and here's where we are on the NASDAQ 100 relative to that gap down. So anything over the last 7 days that looks better than that chart is certainly something that deserves to go on your watch list. And that is going to wrap it. So as always, love to hear feedback from you. You can email me, don@revereasset.com, or phone 855 Real Wealth. Wrapping up Tuesday, 6/21. This is Don Vandenbord with Just the Facts, telling it like it is. Stick to price and volume and not opinions, and you'll do just fine. Realize what type of a market we're currently in, and have certain rules to play those markets. So thanks for listening and have a great day.